Welcome to Smart Investing, where we demystify the world of stocks and portfolios for everyday people like you. I'm here to guide you through building a diversified portfolio, a strategy that's like creating a balanced family budget, spreading resources to weather any storm. Imagine starting your investment journey with confidence, knowing your money works for you over the long haul. Today, we'll explore why diversification matters, backed by data showing that diversified portfolios have historically outperformed single-stock bets by reducing volatility. For instance, the S&P 500's average annual return of about 10% since 1957 comes with ups and downs, but spreading investments smooths the ride. As we begin, think about your goals: retirement, education, or security. This video is your roadmap, presented calmly with facts to empower your decisions. Let's dive in. Building on our introduction, let's talk about why diversification isn't just a buzzword, it's your financial safety net. Picture your portfolio like a family meal. You wouldn't put all your eggs in one basket, or rather, all your nutrition in one food group. Data from Vanguard shows that over 10 years, a diversified portfolio of stocks and bonds returned around 7 to 9% annually with less risk than stocks alone. In contrast, undiversified investments can swing wildly. Remember the 2008 crash, where single-sector funds lost up to 50%? By spreading across asset classes, you mitigate those shocks. For our audience in their 30s to 50s, this means protecting midlife savings from market whims. We'll cover the basics next, using historical trends like the 7% average real return of balanced portfolios since the 1920s. Stay with me as we uncover how to make this work for you. Following our discussion on the why, let's identify the core building blocks of your portfolio: stocks, bonds, and beyond. Stocks represent ownership in companies, offering growth potential. Think of them as seeds in your garden that can bloom over time. Historically, U.S. stocks have averaged 10% annual returns, but with volatility. Bonds, on the other hand, are like steady savings accounts from governments or corporations, providing income with lower risk. They've returned about 5% annually. Don't forget alternatives like real estate or commodities for extra diversification. For someone in their 40s planning for retirement, a mix might be 60% stocks, 30% bonds, and 10% others per Fidelity's guidelines. This allocation draws from data showing balanced portfolios weather recessions better, losing only 20 to 30% in downturns versus 50% for stocks alone. As we progress, consider how these pieces fit your life puzzle. Now that we've outlined the assets, assessing your risk tolerance is crucial. It's like knowing how much spice your palate can handle in a recipe. For mid-career professionals, this means evaluating your age, income stability, and goals. A 40-year-old might tolerate moderate risk for growth, aiming for 7 to 8% returns, while someone nearing 55 prefers conservative bonds to preserve capital. Tools like Vanguard's investor questionnaire help quantify this. Data indicates that mismatched risk leads to 20% more panic selling during dips. Historically, those who stuck to their tolerance saw portfolios recover faster post-2008. Think of it as tailoring your financial wardrobe to life seasons. By aligning risk with reality, you build resilience. Next, we'll see how to allocate these assets strategically, ensuring your portfolio mirrors your assessed comfort level. With risk tolerance in mind, strategic allocation is where the magic happens, like dividing your grocery budget across essentials and treats. A common rule for our age group is the 100 minus age for stock percentage. At 40, 60% stocks; at 55, 45%. Backed by Morningstar data, this glide path has delivered 6 to 8% average returns with controlled drawdowns. Include international stocks for global exposure, about 20 to 30%, as they've added 1 to 2% to returns historically without extra risk. Bonds provide ballast, cushioning against stock slumps, as seen in the 2022 bear market where balanced portfolios fell only 16% versus 25% for stocks. Adjust for your situation: more bonds if you have dependents. This isn't set in stone, it's a starting point. As we move forward, discover how index funds simplify this process, making diversification accessible and cost-effective. Transitioning from allocation, index funds are the unsung heroes for beginners. Think of them as a pre-packed meal kit for investing, easy and efficient. These funds track broad markets like the S&P 500, offering instant diversification at low costs, with expense ratios under 0.1%. Data from S&P Dow Jones reveals that over 15 years, 88% of active funds underperformed their index counterparts. For long-term holders in their 40s and 50s, this means steady growth. The Vanguard Total Stock Market Index has returned over 9% annually since inception. Pair with bond indexes for balance. No need to pick winners, let the market work. This approach suits busy professionals, saving time and fees. Historically, during the dot-com bust, index investors recovered faster due to broad exposure. Next, learn the importance of rebalancing to keep your portfolio on track. Following index funds, rebalancing is the maintenance that keeps your portfolio healthy, like trimming hedges in your garden to maintain shape. Over time, winners like stocks can grow beyond your target, increasing risk. Annually or when drifts exceed 5%, sell high and buy low to reset. Schwab studies show rebalanced portfolios outperformed non-rebalanced by 1.5% annually over decades. For example, post-2020 bull run, trimming stocks prevented overexposure before 2022's dip. This disciplined approach, rooted in data, ensures your risk tolerance stays intact. Tools like robo-advisors automate this for under $100 yearly. For our viewers balancing careers and family, it's a set-it-and-forget-it strategy promoting peace of mind. As we continue, we'll address pitfalls to sidestep on this path. Building on rebalancing, let's avoid common mistakes that trip up even seasoned investors, like trying to time the market, which studies from DALBAR show costs individuals 4 to 5% in annual returns due to emotional buys and sells. Another pitfall, overconcentration in hot stocks, reminiscent of the 2000 tech bubble burst where many lost half their value. For those in their prime earning years, chasing trends ignores diversification's power. Instead, stick to your plan. Data from the CFA Institute indicates consistent investors achieve 7% real returns over 20 years. Emotional discipline is key. Treat dips as sales, not disasters. By sidestepping these, your portfolio grows steadily. Now, let's examine historical performance to reinforce why this works long-term. After dodging pitfalls, historical insights illuminate the path, like a rearview mirror showing how diversified portfolios endure. From the Great Depression to the 2020 pandemic, balanced investments have rebounded resiliently. NYU data reveals a 60-40 stock-bond portfolio's worst year was minus 26% in 1931, but it averaged 8.5% over 90 years. In contrast, all-stock portfolios saw minus 43% drops. For retirement planners, this means weathering storms without derailing goals. A $10,000 investment in 1990 would be over $100,000 today, adjusted for inflation. These patterns build trust in the process. As we approach key decisions, equip yourself with tools and resources tailored for beginners. With history as our guide, now face the pivotal decisions that shape your portfolio, like choosing the right vehicle for a cross-country trip. Start with your brokerage, low-fee options like Vanguard or Fidelity, where index funds cost pennies on the dollar. Decide on contributions, aim for 15% of income per financial planners to leverage compounding. $500 monthly at 7% grows to $1 million in 30 years. International exposure. Yes, 20% to capture emerging markets, 8 to 10% growth. ESG factors if values align, but data shows they match traditional returns. These choices, informed by your risk profile, are the climax of building confidence. Weigh them calmly, no rush. Next, we'll outline long-term strategies to sustain this momentum. Culminating our core lessons, long-term strategies ensure your portfolio thrives, like nurturing a tree for lifelong shade. Automate investments to dollar-cost average, buying more shares when prices dip. This has boosted returns by 2% over lump sums in volatile periods, per Vanguard. Glide toward conservatism as you age, shifting 1% annually from stocks to bonds. Monitor taxes via Roth IRAs for tax-free growth, ideal for midlifers. Inflation hedge with TIPS bonds, maintaining 2 to 3% real returns, data affirms. Patient investors since 1970 captured 9.5% annualized despite crashes. Review yearly but avoid tinkering. This patient approach empowers you toward financial independence. Finally, let's wrap with steps to get started today. As we conclude our journey, remember, building a diversified portfolio is about steady progress, not perfection, like planning a family legacy that endures. Key takeaways. Assess your risk, allocate wisely with index funds, rebalance regularly, and stay the course. Start small, open an account today, and invest $100 weekly. Historical data promises rewards. A diversified start now could double your nest egg every 10 years at 7%. You've gained the tools for clarity and control. Thank you for joining Smart Investing. Subscribe for more data-driven insights on stocks and portfolios. Comment your first step below and invest in your future with confidence. Until next time, invest smartly.